we had a fantastic run today. And that's thanks to some positive signs that China might be willing to make some sort of trade deal, this phase 1, phase 2 thing. We'll find out on Monday. But I think this market still requires a degree of caution. Maybe the Chinese changed their minds over the weekend. And we go right back down. I mean, maybe there's not an ag buy and there is an ag buy. I don't know. We don't know. I mean, just a total guessing game. Market went down big when we first heard that it's just some, phase 1, phase 2. That's why we have to hunt for secular growth stories that can work regardless of what substantial progress we've made and what phase 1 or phase 2 really is. Which brings me to the golf stocks. Yep. For the last 3 years, golf's making an incredible comeback. And that's why I keep pounding the table on this theme. Thanks to the rise of interactive driving ranges like Topgolf, which all of my friends love. They love to go Topgolf, birthdays, things like that. The younger generation is now taking an interest in what used to be a pretty sedate sport. These chains use technology to turn something that used to be slow and boring, at least to me. A driving range isn't exactly where you go for excitement. And it's something that's really a lot faster and more competitive. It's fun. Now, 6 months ago, I recommended Acushnet Holdings and Callaway Golf again. They're now up roughly 12 and 21%, respectively. During a period where the S&P is up just less than 3%. Acushnet's the parent company of two major golf brands you may have heard of, Titleist for equipment and FootJoy for cleats and apparel. Callaway makes everything from equipment to apparel, and it also owns a minority stake in, yes, the red-hot Topgolf. Now, the last time I checked in on these guys, I thought Acushnet was a safer bet. Callaway was more risky. Turns out that I got it backwards. Over the past 6 months, Acushnet's reported a couple of noticeably bad quarters. Disappointed in May, and then they did it again in September. Companies had some serious self-inflicted wounds, like production problems with their new putter. They also got more organic challenges. You can chase it out here, like tough comparisons to Japan, rainy weather in the United States. People play less golf when it rains. That's something I learned when I was doing the research. Although I should point out, total rounds played were basically flat in June and July, even though we had a lot of unseasonable rain this summer. What's amazing about Acushnet is that these disappointments haven't done much at all to derail the stock. Look at this winner, okay? Management has maintained their full-year organic sales and earnings forecast, so it's hanging in there. That's what matters. When you maintain your forecast, people don't get too upset when you miss a little bit. It's up 12% since the last time we highlighted it in April. Now, I owe a mea culpa here, though. Well, Acushnet's made you money if you bought it on my recommendation, and it's outperformed the average. It way underperformed Callaway. I mistakenly thought that Acushnet was the better bet. Still, even after some not-so-hot performance, I'm optimistic about the next quarter. We finally got a sustained period of dry weather, good for golf, and they should be able to get their production issues back on track. On the other hand, though, even though I recommended Callaway, I told you it was the riskier way to play the golf industry. No, I was wrong. Callaway remains awesome. I should never have flipped my rankings in April. It was a mistake, particularly because look at this, huh? What a chance that was. But we liked it here. We've liked this for a long time. What can I tell you? It really is just a huge winner. The problem, in February, the company gave us some disappointing full-year guidance. I should have had more faith in management because it happens they were really just kind of pulling some classic UPOD, which is, we know is under-promise and over-deliver. Since then, Callaway's reported two terrific beat-and-race quarters in a row. They knocked it out of the park in May, and they did it again in August. Companies had some strong product launches. Their golf balls are selling like hotcakes. And management's been very good about maintaining tight control over their expenses. Even when the broader golf industry stagnates like it did in the second quarter, Callaway's core golf business keeps growing. Epic drivers, Chrome soft golf balls, Travis Matthew apparel, they're all very strong. And management has now raised its full-year forecast back to where it was when it wanted to be, when they gave seemingly light guidance in February. The other worry with Callaway involved the company's acquisition of Jack Wolfskin. That's a German maker of outdoor apparel and equipment, not to mention sports gear. Callaway closed this deal at the beginning of January, and just a couple months later, they cut their sales forecast for the brand, thanks to weaker-than-expected pre-bookings for the fall and winter season. But over the summer, Callaway's management spoke to Randy Connick, the analyst who covers the stock for Jefferies, and they painted a pretty positive picture. They point out that Wall Street tends to underestimate Jack Wolfskin because it's a global brand with relatively limited U.S. exposure. Wall Street's just not familiar with it. Plus, Callaway has a terrific track record when it comes to integrating acquisitions. 2 years ago, they bought Travis Matthew, the golf apparel business, and it's now one of their hottest brands. Fast forward to August, when the company reported its most recent quarter, and Jack Wolfskin turns out to be on fire. 14% growth, thanks to some incredible strength from its online business. Oh, and Callaway's planning a broader North American launch for it sometime in the second half of next year. I thought the brand was a negative. It turns out to be a major positive. Most importantly for Callaway, though, we in June learned that Jana Partners, that's J-A-N-A, Jana Partners, the big activist hedge fund, had taken a 9.5% stake in the company. The guys at Jana believe Callaway stock is too cheap, and they want the company to either put itself up for sale or divest some business in order to unlock value. I think this company's been extremely well run, but I can't complain about an activist coming in and lighting a fire under management, especially when that activist firm is a totally heavy hitter like Jana. And that's this last bit of part I think is really Jana. Sure enough, in August, Callaway raised its buyback. And then earlier this week, we learned that Topgolf might be planning to come public next year. Finally, an IPO that I might want. Topgolf's the major interactive driving range change, and Callaway owns 14% of the business. There's a widespread sense that they don't get enough credit for this investment. Callaway trades at $20 and change. Their Topgolf stake might be worth as much as $3 to $4 per share. If Topgolf comes public, and here's the only, I always say just say no to IPOs. I might change my mind about this one. Got to see the numbers, of course. Callaway can ring the register in the position, but even if they don't sell it, I'm betting the stock will more fully reflect the value of this terrific asset. Once Topgolf has its own valuation, well, analysts can just plug in some of the parts model, SOTP as we call it. So here we have a fabulous company with great fundamentals, a huge potential catalyst, an activist hedge fund pushing for even more value creation. But the best thing about Callaway is that even after the stock's monster run, up 10% since the Topgolf IPO story broke on Tuesday, the stock still sells for just 16 times next year's earnings estimate, cheaper than the average stock. Finally, there are also plenty of ancillary golf plays. Nike's got a good golf business. It's been very strong. I think it's absolutely worth sticking with. I like the stock in Nike, even up here, okay? And then especially we're experiencing a real thaw with China, of course. It would be even better for Nike. Comcast, the parent company of this network, also happens to own the Golf Channel, which has been very creative about monetizing their viewer base. They've got a subscription streaming service and an online store for all things golf. Comcast stock has been on fire since the transformational acquisition of Sky. That's that giant British broadcaster. But please don't forget this one, EPR Properties. It's a real estate investment trust focused on entertainment, recreation, and education assets, including, yes, 35 Topgolf facilities. That's roughly 12% of the total portfolio. That's how I know about Topgolf. EPR has been an excellent performer over the last 18 months. And even here, despite the fact the stock's run 5.8% yield. You want yield? You want income? EPR. Bottom line, when you find a powerful secular trend that just keeps working, you got to stick with it. Golf is working, and that's why you got to stick with Callaway and even Acushnet, although if you have to pick one, after what I've said, it's Callaway. And don't forget, if you want yield, I suggest you go with EPR. Stick with Cramer.
Don't miss a second of Mad Money. Follow @Jim Cramer on Twitter. Have a question? Tweet Cramer. #MadTweets. Send Jim an email to madmoney@cnbc.com or give us a call at 1-800-743-CNBC. Miss something? Head to madmoney.cnbc.com.